In the first video, I showed you how Aratsankaran, an Indian viewer of my channel, helped me to find a great company, Asian Paints. In this second video, I'll show you the analysis of the company, including the calculation of the value. I promise you'll be surprised to see what the value is in relation to the price. This is going to be a bit longer video, so grab some popcorn, get a drink and put your feet on your desk. Let's start with having a quick check at what the company is doing and where they are now. Asian Paints produces, as the name already reveals, paints. Decorative paints for the private use, industrial paints, but also coatings and industrial finishing products. They are based in Mumbai, India and have around 7,600 employees. In 2020, they generated a turnover of 205 billion rupees, which is around 2.8 billion US dollar. Apart from India and Asia, they are also operating in Africa, in the Middle East, with strong and well-positioned brands like Asian Paints, Causeway Paints, Berger, Kadisco, Scib, and Taubmans. One thing I like about them is that a majority stake of nearly 53% is still owned by 3 of the 4 families of the founders. For me, it is a good sign if there's a group of people that has a long-term interest in a company to grow. When you want to make a projection on how a company will perform in the future, it is usually a good idea to look at how they did in the past. Therefore, let's have a look in the rear mirror and check out their financial performance in the past decade. How did they perform in terms of improving their free cash flow? To find this out, I downloaded the available annual reports from the past 16 years. Then I scrolled down to the section of the consolidated financial sheets and transferred the cash flow from operations, CAPEX, and the proceeds from the sale of CAPEX to my Microsoft Excel company evaluation spreadsheet. You can download it from my website tiltarara.com if you like, of course for free. The direct link will also be included in the box below the video. The downloading and transferring might be a bit boring to look at, so I'll fast forward through this. Even without deeper calculations, you can already see at the first glance that they steadily grew their free cash flow from circa 0.4 billion rupees in 2005 to 17.6 billion rupees in 2020. In US dollar, this is a development from circa 5.2 million to $236 million. Between 2005 and 2020, Asian Paints grew their free cash flow on average by 29%. That is highly impressive. What's also highly interesting is the development of the capital they require to run their business, the CAPEX. When you look at the development of the CAPEX of the individual years, it seems that their required money jumps up and down like crazy. But this is normal for companies. Companies don't grow as steady and smooth like the business schools and Wall Street want them to. It's more like with the growth of babies. Sometimes they suddenly grow much faster and then it takes a bit for them to grow. A lot of parents probably know what I mean. Sometimes companies see an opportunity to invest in a product and then again, it takes some time to find something promising. This is why it is also interesting to look at the 5-year average. When you look at the chart, you'll see immediately that the 5-year averaging is smoothing this out and all of a sudden you can see Asian Paints' requirement of capital growth with the increase of the business. It really looks like they are doing a pretty good job with growing their free cash flow. But how easy or difficult will it be for them to grow in the future? To answer this question, we look at the financial figure that tells us how much cash a company generates on every dollar of invested capital, the CROIC, the cash return on invested capital. Because for a company that requires a lot of capital to generate additional cash, it will obviously be harder to grow. When you want to refresh your memory on the IC and CROIC topic, here in the corner is a link to a short video explaining these figures. While I already had the financial sheets open, I directly used them to transfer the required data for calculating the invested capital and the CROIC to my spreadsheet. This is easy because apart from the free cash flow that we already calculated, we just need the long-term debts and the shareholders' equity. I'm also going fast forward through this. You see that the CROIC went down in the past years, but it seems to have stabilized on a level of around 15% now. That means that Asian Paints is able to generate 15% on every additional rupee or dollar they invest in. In the more distant past, their CROIC was even stronger, but I'm usually careful and try to be a bit more on the safe side. This is an additional margin of safety for me. There could be several reasons for the drop in the CROIC rate. For example, they could have invested in businesses with a lower CROIC rate, or their product mix shifted toward products with a lower CROIC rate. This doesn't have to be a deterioration of the CROIC in general. To really find this out, we would have to do a deep dive analysis of the company, which would be a bit too much for this video. But maybe you have an idea on this. Let me know in the comments below the video. Personally, I think that 15% is still a good CROIC rate. The asset and debt situation. Let's see if there are any promising figures in the balance sheet. The asset and debt situation can break the neck of a company if it is coming in a crisis situation. Believe me, I personally made the mistake about 12 years ago to not look closely enough to the balance sheet of an investment. The target is to understand the liquidation value, also called the shareholders' equity. If a company would go bankrupt, it would have to sell all of its assets and pay back all of the liabilities. What's left belongs to the owners. And this is the liquidation value. The balance sheet already contains a figure that shows the equity that belongs to the owners. Unfortunately, it is created by the accounting standards and is often not very reliable. Therefore, we will calculate the shareholders' equity ourselves. Don't worry, it is not that complex. We start with the current assets. Those are assets that could be liquidated quickly. I usually take the financial assets as is. I adjust the inventories a bit and consider them only with 80%. In case of a bankruptcy, the company might have to sell their products under pressure, which would reduce the prices. The non-current assets are all the assets that cannot be liquidated that easily. Like for example machines, buildings, IPRs, etc. With these, I'm usually quite careful. The section property, plant and equipment is the biggest position in this case. I consider it with 50% of the value. Intangible assets like goodwill, patents or rights of use assets are one of the most difficult items to be evaluated. When it is too hard, just leave it out. This is another margin of safety in case you later consider to invest. I will do the same for the other positions of the non-current assets and just ignore them. You will understand later in this video why this is not a problem. Our carefully adjusted assets have a calculated value of circa 65 billion rupees. We deduct all of the liabilities from this figure, so the current and the non-current liabilities. Our shareholders' equity is circa 45 billion rupees. That is circa 0.6 billion US dollar. For me, this is a good sign. Even in a crisis situation, Asian Paints could pay back nearly all of its liabilities just with the current assets. This is reducing the risk of a bankruptcy already a lot, and by this, also the investment risk of the shareholders. Risks. What's even more important than looking at the growth and the upside potentials is the potential downside. When you buy a stock, you should spend the majority of the time for your analysis with investigating the risks of a business and the investment. This video obviously can only provide you with a quick overview about this. So, when you're seriously considering to invest in a stock, you have to walk the full mile, and this means no shortcuts. This being said, let's have a quick look at the potential fields of risks for Asian Paints. The brand. The brand is at the moment definitely not a risk, but an asset for Asian Paints. They built it up since nearly 80 years. My personal view is that there are basically 3 ways to win in the paint market. Number 1, to have the absolute lowest cost. Number 2, to have a really strong brand. And number 3, of course, to have a strong distribution network, which means to be available everywhere people require and search for paint. When you continue to follow Asian Paints, especially look out for how they strengthen their brand, how they do marketing-wise. This is, by my assumption, one of the key drivers for where they will be at in 10 or 15 years from now. Competition. The Indian and the Asian markets are definitely growing, and therefore they will be highly interesting for other, bigger and globally operating companies. Like, for example, Sherwin-Williams or AkzoNobel or Nippon Paint. But ask yourself as a consumer, why would you choose a product from a new and less known brand over a well-established brand like Asian Paints? Also, I would be highly surprised if an Indian company would lose on product costs against a European or American company. And I also don't expect many technical advantages of the competitors' products. That's the beauty of a product group whose technology isn't evolving fast anymore. The business is way more predictable. When it's not cost or technology, I believe that people will choose on brand. And building a brand in a new market costs a lot of money. And this is why I do not think that competition itself is going to be a risk. Product and development. Paints are not a high technology product with fast-paced product updates and short product cycles. This may seem boring to you, and I'm with you that it is definitely more interesting to follow the development cycles and product updates of smartphones. But this is something that is reducing your investment risk. When there are not that many updates and changes, there are simply not that many possibilities for your existing products to deteriorate in value for your customers. And there are simply less chances for your competitors to conquer your markets. Of course, it is possible to imagine improved paints. For example, with better weather protection or longer durability, more sustainable ingredients, maybe even with cooling effects for houses in a world of changing climate. Asian Paints has a research and technology facility in India with over 200 scientists. They are adapting technologies and developing new products. It looks like they are not missing the boat here. So I consider also this as a low risk. But as an investor, it is something that I would follow regularly in the future. Management. This is the biggest question mark in the risk analysis for me, because you need to understand how the management behaves in critical situations, how they communicate to employees and shareholders, if they are honest, and how they are handling personal mistakes, which occur from time to time because we are all humans. You will only find this if you read a lot and gather information. And this takes some time. To be clear, what I read so far didn't raise any flags or warning signs. But again, if you consider to invest in a company, you better try to get a deep understanding about their management and erase this question mark. Approaching the value. When your analysis showed you that you found a great company, of course you also want to know the fair value and if it is worth a price. So let's do this and calculate, or better yet, to approach the inner value. The first part of the inner value we already calculated, the shareholders' equity. We just transfer our calculated figure and put it into the company evaluation spreadsheet. The second part is to project the free cash flows of the future and calculate today's value of it. To do this, we start with today's free cash flow and put it also in our spreadsheet. Now we need to estimate the future growth of it. This is the difficult part, that when you do this yourself, you should put a lot of thought into it. But we have some indications that help us and that we found out in the first part of this video. We know that Asian Paints free cash flow grew on average with circa 29% in the past 16 years. But with the increasing size of the company, it slowed down a bit and was in the past 5 years around 18%. Let's assume that they start growing with the average of the past 5 years. To be a bit more careful, we assume that the growth slows down in the next 10 years by 10% every year, and afterwards it stays at circa 6% per year for the following 5 years. The formulas in the spreadsheet already consider this. To find out today's value of the future free cash flows, we have to discount them to today. Let's take a discount rate of 10% for this. If you want to know why and how discounting works, I'll put a link here in the corner to a short video that will explain this. Putting a discount rate of 10% in our spreadsheet automatically calculates today's value of all future free cash flows with 301 billion rupees, that is circa $4 billion US. Adding this to the shareholders' equity, we receive a company's value of circa 346 billion rupees, that is $4.65 billion US. Now you also see why it was no problem to just leave some items out while calculating the shareholders' equity. They wouldn't have influenced the total value of the company that much. When you divide the total value by the number of stocks, you'll receive a value of circa 360 rupees per stock, that is $4.85 per stock. To calculate your purchasing price, you have to consider that you may have made mistakes in your calculations or that you have been overly optimistic with some assumptions. Therefore, you have to deduct your personal margin of safety to come to your desired purchasing price. How you do this, I'll show you in another video. For now, let's have a look at the stock price and see how close it is to our calculated value. Today, as of end of August 2021, a stock of Asian Paints costs circa 3,100 rupees. That is circa $41.68. This is about 8.5 times more than what our calculation revealed as the inner value. To justify a valuation of 3,100 rupees per stock, Asian Paints would have to grow with more than 40% per year in the future. This seems to be incredibly optimistic to me. I don't say that it is impossible, but looking at the past years, Asian Paints would have to speed up their growth a lot, just to justify the current price at the stock markets. Just to be clear, this does not make Asian Paints a bad company, and it also doesn't mean that the management did a bad job. It just means that the stock markets act sometimes completely crazy in both directions. My personal interpretation is at the moment that the growth of the past 15 years somehow messed up the mind of Mr. Market. Of course, I double-checked all of my calculations if I made any mistakes. So far, I'm pretty confident that they are okay. But if you have another opinion, drop me a comment below the video. This price seems to be weirdly high. Before we do a quick summary, it would be really helpful for me if you give the video a thumbs up in case you liked it. So let's do the promised quick summary, why Asian Paints is a great company. In a nutshell, Asian Paints is a great company that is positioned extremely well with a strong brand, generating highly attractive free cash flows. And they generate so much of it that they don't have a problem with letting their owners participate by regularly distributing dividends. They proved in the past decades that they are very well able to grow their business nicely, organically, but also by taking over and integrating other companies. Asian Paints will definitely be on my watch list in the future, but I think it will take some turmoils in the markets before their stock price falls to a level that is tempting for me. If you found this interesting and if you want to learn more about investing and building your fortune, you should definitely check out this video here. See you in the next one.